Feelings can be a wonderful thing. Just think how good it feels when a whole portfolio glows green, or when Snoop Dogg moves in next to your virtual NFT property and you become a millionaire overnight. Unfortunately, the stock market is not only about nice feelings, and often fear and greed are the reason why investors lose a lot of money on the stock market. In this video, you will learn how emotions influence your investment decisions and what you can do to make rational rather than emotional decisions. But before we start, please notice that this video is for educational purpose only. This video is not for financial advice, and I am not your financial advisor. Always be responsible for your own financial decisions. Let me tell you a little story about Bob and Alice. Bob and Alice are happily married and live in a small village in California. One day, Bob gets a tip from his friend Daniel about a super investment chance. Daniel tells Bob about this super cheap gold producer, the highly speculative Explorer Corporation, which is traded far below the intrinsic value. Bob doesn't know anything about investing in gold producers, but trusts Daniel's assessment and buys 1,000 shares for $1. On the same day, Alice, Bob's wife, goes to her weekly shopping. There, she sees an offer for flour. The flour costs only $1 today instead of the usual $2. Because Alice is passionate about baking bread and knows that flour will become more expensive again, she buys 10 pieces right away. A month later, Bob looks at the app of his online broker and sees that his stock has risen from $1 to $2. Out of sheer joy, Bob directly buys more shares for $1,000. He thus holds 1,500 shares for $3,000 for the highly speculative Explorer Corporation. On the same day, Alice goes to the nearby shopping center again. While shopping, she finds that flour has gone up $3 because there are temporary supply shortages. She decides not to buy more at this time because she thinks the price is too expensive. Another month later, Bob is shocked to find that highly speculative Explorer Corporation has fallen from $2 to just 50 cents. Which brings the value of his stock down from $3,000 to just $750. Bob panics and sells all his shares at a loss of $1,250. A short time later, the company announces that it is now ready to start production after a long development period. The share price rises to $10, which means that Bob's shares are now worth $15,000 if he had not sold them early. What did Bob do wrong? Since he relied only on the judgment of a friend in making the investment, it is impossible for Tom to know the intrinsic value of the company. If Bob had known that the company was about to start production, he probably would have acted differently, and maybe even increased his position to have an even bigger profit in the end. Bob's problem is that he needs price verification to be convinced of his investment. If the price rises, he feels confirmed. If the price drops, he loses confidence. His wife, Alice, on the other hand, knew the intrinsic value of the flour and was able to take advantage of the low price. Bob is not alone in this problem. Many investors need price verification for their investments, which often leads to buying high and selling low because fear of loss takes over. A good exercise that anyone can do is to ask yourself for each stock in your portfolio if you would buy the stock if it fell 50% and nothing fundamentally changed about the company. If you find it difficult to find an answer to the question, it is probably recommended that you look more closely at the company. The consequences of price verification are always there. For example, if we take a look at the relationship between commodities and the S&P 500, we can see that commodities are currently still at a low point compared to the broad American stock market. Even if commodities look much more attractive than the S&P 500, the enthusiasm of private investors is rather limited, and they prefer to invest in above-average valued S&P 500 companies than in attractively valued commodity producers. If you want to learn more about ratio charts, I can recommend a video on the subject that I recently produced. You can find the video in the description. What can we learn from all this? Study the companies you invest in and only invest in companies you really understand, so you can buy with a clear conscience when Mr. Market sells you the stock at a discount. If the stock of a company falls, first see if the fundamental situation of the company has changed. For example, has the highly speculative Explorer Corporation gold mine collapsed, or has the entire sector simply corrected sharply? If you really understand the companies you are investing in, you can make rational decisions instead of emotional ones, and you will get a better return in the long run. Have you ever been a victim of price verification? Write it down in the comments below. If you like this kind of content, don't forget to give the video a thumbs up and subscribe to the channel.